Hi guys, welcome to BCCA. This is Sierra Viteja and I'm the faculty for Corporate Financial Reporting at CMA Final Level. As promised for December 2025 students, I have already come up with full comprehensive marathon which is released in two parts, and not only that, I have also come up with theoretical portion also. Complete theory have been very nicely explained, and not only that, I have come up with some important questions for theory as well. And finally, the final support from my end is this MCQ ka sessions is also being released as of now. Actually, this video should be uploaded the day before yesterday only. The day before yesterday only, this video should be uploaded. But the thing is, because of some technical issues, the video is unable to upload. So what I have decided is I have recorded another video. Okay, but it's not at all a big problem. This video has come up very nicely. So first clarity which I wanted to give to you students is this MCQ ka video will be released in two parts. First part में whatever the new MCQ bank which is released by the institute, that is very much covered. That is completely covered. I have not even left a single MCQ also. So whatever the institute released recent MCQ ka compilation is clear cutly explained in this part. So this MCQs will be released in basically two parts. One second. In two parts. So this is the first video which will be uploading. Second video will be uploaded by tomorrow itself. Okay, you no need to worry at all. There is no rush. You have to watch this MCQs carefully and slowly, because the weightage of this MCQs is not less, guys. It is 30 marks. So I can confidently say that if you watch these two parts, no one can stop you from getting 30 out of 30, and that is my assurance. You can completely rely upon that. Every source have been discussed. In this part 1, new compilation of MCQs of institute, this MCQ ka bank has been clear-cutly explained. And in the second part, though, whatever the exam questions and whatever the MCQs which are there at the end of each chapter, those will be covered in the second part. Okay, most of the MCQs in that second part will be little bit repeated from this part 1, but my sincere advice is just watch both. Just watch both to get a total of 30 out of 30. Okay, yes sir. So my support for this December 2025 students with respect to the subject CFR is already given. I will be coming up with another video which is a kind of LDR, last day revision. What should be your approach? What should be your strategy and all? I will be releasing that another video. Other than that, everything is sorted. I wish you guys should definitely get a minimum of 80 plus in this upcoming attempt. With all the support which I have given, with your hard work, you will definitely get that. There is no second thought about that part. Okay, so that's it guys. Very all the best. On the results day, you have to message me, sir, that I have secured an exemption. I have secured 80 plus. I was waiting for that. I have already decided that whoever the student has watched it, the marathons theoretical part along with this MCQs will definitely get 90 plus. I have already fixed that part. Okay, so you just have to mention in the comment box where you are watching this video from. That will give me enough motivation and I will understand that this video is reached till which places. Okay, so that's it guys. Thank you so much and very all the best. So hi guys, without wasting any time, let us directly start with the most important MCQs ka publications which are made by the institute. These are nothing but the recent MCQ ka bank which is recently released by the institute. Okay, so let us quickly dive all the MCQs and then let us analyze, sir, is it essential to discuss chapter wise MCQs also? That also I have already categorized very nicely. I have arranged it chapter wise, and once we are done with all the MCQ ka compilation from all the chapters, then probably we can start with that. So the primary importance we have to give to the institute ka recent publication. So without wasting any time, let us directly start with the things. Okay, so first one, very easiest one, it is nothing but Ind AS 113 stands for. It is very simple guys. Ind AS 113 though stands for fair value measurement. Whereas this consolidated financial statements have been discussed in Ind AS 110 and Ind AS 28. share-based payment का standard is being discussed in Ind AS 102 and financial instruments का standard has been discussed in 10. Multiple standards are there basically. 32 also we have discussed and 109 maybe we have discussed financial instruments का discussion. ठीक है, fine sir. So the right option is Ind AS 113 stands for this fair value measurement. ठीक है, fine sir. Just a moment. Yes, sir. Second thing though. Sir, share-based payments are dealt in which standard? That is nothing but Ind AS 102. Just now I have explained that Ind AS 102 may they will go ahead and discuss share-based payments का valuation. ठीक है sir. Third part, dash Ind AS shall be applied in selection and applying accounting policies, accounting for change in accounting policies, changes in accounting estimates and correction of prior period items. Guys, this related standard is being discussed in Ind AS 8. Ind AS 8 may they have discussed about changes in accounting policies and changes in accounting estimates, and if there are any prior period ka adjustments also, so how we have to do, and all the things have been discussed in Ind AS 8. We all know that. So this Ind AS 12 talks about deferred tax assets. Income taxes related standard is discussed in Ind AS 12. 16 talks about PPE and 21 talks about foreign exchange, changes in foreign exchange transactions, and all has been discussed in Ind AS 21. So even if you eliminate the transactions, even if you eliminate those options which are not necessary, you can still able to solve this question, and the right answer is Ind AS 8. Okay. The next one. Fourth one, if you observe, very basic sa question, little bit of impairment knowledge is what they have tested in this question. So let us quickly check the part. A Limited has a machine whose original cost is 45,000 rupees. The accumulated depreciation on the machine is 15,000 rupees. Cost they have given 45,000. Depreciation they have given 15,000. So here let me write a carrying amount. Sir, carrying amount is nothing but 30,000 rupees. Okay. Similar machine has been recently sold in the market for 25,000 with selling expenses of 2,000 rupees. So they have given fair market value also, and they have given expenses to sell also. Sir, can't we calculate fair value less cost to dispose? Fair value less cost to dispose is nothing but 23,000, sir. Understood? Second part, they have given, sir, management determined the entity specific present value of future cash flows of the machine is 28,000 rupees. This is nothing but value in use of the machinery. Value in use of the machinery is how much, sir? It is nothing but 28,000 rupees. Sir, what the question is asking, guys? The question is simply asking about the recoverable amount. We all know that. So recoverable amount is nothing but higher of value in use or FELCTD. Higher of value in use or FELCTD is nothing but our recoverable amount that we have been already discussed in the standard. So the right answer is 23,000 or 28,000, whichever is higher. Therefore, the answer has to be 28,000. The answer has to be 28,000. Okay. So I think there's a little mistake in this question with respect to the answer. I think they have given an option of 23,000, which is not correct. If they have asked FELCTD, your answer will be 23,000. But since they have asked recoverable amount, we have to find out which amount is higher. The higher amount is nothing but 28,000. Therefore, there is a mistake in the answer. Please check that part. Understood, sir. The major approaches to valuation of the shares. The major approaches to valuation of the shares. Shares ka valuation can be done in multiple approaches. This we have been already discussed in valuation of shares and goodwill ka topic. First one to income approach also we have understood. Net assets approach also we have understood, and market approach also we have understood. If you remember valuation of shares ka chapter. Based on net assets of the entity also we have understood how to calculate the valuation of share. In some cases, our SFM, they have discussed some dividend valuation, okay, yield valuation approaches, which are nothing but those are income approaches. And the market approach may, in one question, typically they have given multiples of comparable companies, and we have to find out certain ratios based on the comparable companies, and we have to apply those ratios with the current multiples of our company. Then we will be taking the average of all things. Like that also we will be finding out the intrinsic valuation of the share. Understood? Yes, sir. So correctly speaking, the fifth answer may all of the above will become the right answer. because all these methods are nothing but valuation of shares ka approaches only. And next part, the major basis of asset valuation. Similar question. This question also, if you observe, if you are finding out any valuation of asset, this they will little bit discuss in Ind AS 113. So there you will come to know that sometimes book values will be relevant, net replacement value and net realizable value. So for asset valuation of a going concern, we will be taking all the above. We will be considering sometimes book value also, sometimes replacement value also. Replacement value is nothing but how much you have to incur to replace the existing asset with a new asset. This thing now you will be finding out in your SCMDM also. Sometimes a decision making replacement value is essential, sometimes book values are essential, and sometimes realizable values should be essential. So this option will be all of the above. All of the above. ठीक है sir. Next thing though. The income approach for valuation of shares include the following techniques. Income valuation, if you remember, dividend model is also there, earnings model is also there, profit based valuation is also there, which is nothing but discounted cash flow technique, dividend discounting technique, and maintainable profit basis, which is nothing but earnings basis. So all the above will be treated as approaches for valuation of the shares. So right answer will be D. Right answer will be D. Okay, sir. Next thing, some methods of the goodwill valuation they have given. Goodwill valuation we have already remembered. We have discussed very nicely in our regular batch. Capitalization method is there. Super profits method, average profits method, and last may all of the above. We have discussed different formulas also. Normal profits, super profits, capitalization method. Okay, and last thing is also there, which you have already know that the net assets valuation pay, we will be calculating that part also. So all these are nothing but valuation of goodwill only. Okay, yes sir. So right answer will be all of the above. If you observe most of the questions, if you don't know the answer, you can select this all of the above or none of the above. But you have to be very careful with that. If you know something, don't do these kind of stunts. If you don't know anything, then you can take the risk. Then you can take the risk and you can obviously select all of the above option. It works in majority of the cases. Mark my words very carefully. It works in majority of the cases and not all the cases. Okay? Yes, sir. Next part. The ways of determining the value of the goodwill using the capitalization approach. In capitalization approach, we are having two methods. So first one, though, we can capitalize average profits also, and second method, though, we can capitalize super profits also. Just refer to the goodwill notes what we have written. Then you will understand capitalization can be done even for average profits and even for super profits also. So the right answer will be both 1 and 2. Both 1 and 2 will become the right answer for this 9th question. Okay, sir. Our next part, 10th. This is nothing but related to Ind AS 16. So some standard knowledge you have to understand, but that is also not essential. If you just read with the flow, you will finish this part. This is more like a fill in the blank type of a question, but they have our kind institute have given even options also in order to solve this question. Okay, you just try all these options whether this is filling in this blank or not. Okay, you try, then also you can understand. That much easier this is, but let us try to understand the question. Later what you can do is just you can do the trial and error method of all these options. You will easily understand what is the correct answer is. But since we know the concept already, we can directly attempt the concept. But even if you don't know, still I am saying you can aram se attempt this MCQ. Okay, let's check. First one though. The dash of an item of property, plant and equipment shall be recognized as an asset if it is probable that dash associated with the item will flow to the entity and the dash of the item can be measured reliably. It is nothing but first though, if you remember standard make, we have discussed this part number of times. The cost of an item of a PPE will be recognized as an asset if it is probable that future economic benefits are associated with the item will flow to the entity and the cost of an item can be measured reliably. Standard language of the standard Ind AS 16. The cost of an item of PPE shall be recognized as an asset if and only if it is probable that future economic benefits will flow to the entity, and the cost of an item should be measured reliably. Therefore, the options are first one to cost, second one to FEB, and third one to cost. Very, very easy sa question. Yes, sir, easy sa question. Okay, 10th one is also done, sir. So 10th one ka option is nothing but option number 1. Okay, sir. The next part. PPE are initially recognized at. This also we have already know that. Sir, PPE should be always initially recognized at a cost ka value only. At which value, sir? PPE should be initially recognized at a cost ka value only. Next part you have to understand. Ind AS, this cost includes, if you remember, purchase price also, non-refundable taxes also, all directly attributable expenses which are essential to bring the asset ready to its intended location and condition to be used by the management. This is the standard language. But initially it should recognize that cost. This cost includes purchase price also plus all directly attributable costs also. Okay, basics of point. Next part. Ind AS 113 establishes a fair value hierarchy that categorizes into 3 levels of the inputs to the valuation techniques for measuring the fair value. The hierarchies are dash. This is nothing but basics of value which is there. Very, very basic point which is there. So those are nothing but sometimes what they will say is you have to check prices in the active markets for identical assets or liabilities that the entity can access at the measurement date. First preference you have to give to the quoted prices. Quoted prices in active markets. So with respect to this Ind AS 113, the standard will say how to find out the fair value. First preference you have to find out whether whatever item you are finding the fair value, you have to check whether it is traded in the active market or not. If it is directly traded in the active market, you have to directly take the quoted price of that item of identical asset or liabilities. But sir, it is not there, it is not being trading in active market. Then what we have to do is we have to check the other than quoted prices included in level 1. This is also there. But if any item is unobservable now, then also we have to take some other inputs. So valuation technique में first preference we have to give to level 1, second we have to go to level 2, and third we have to go to level 3. Let me just open from the concept book itself so that it is easy for us to understand. Okay, just a moment guys. Concept book mein, let us quickly check that part. Ind AS 113. So check this. Level 1 inputs you have to give. Level 1 is nothing but active market में what are the quoted market prices. Sir, if that is not there, we have to give our preference to level 2, which means, sir, active market is not there, then we have to make few adjustments to the market price of similar asset. Sir, this is also not there, then what we have to do is we have to go for level 3 inputs. Level 3 may we have to do the assumptions and forecasts, like fair value of the shares, how you are calculating, intrinsic valuation and all, we have to do similarly this part. Okay, yes sir, understood. So next part. So here the right answer is all of the above. 12th main right answer will be all of the above. Okay, fine sir. Next thing. As per Ind AS 113, the widely used valuation techniques are nothing but market approach, cost approach, and income approach. This is also classic case. Directly we can discuss from this only. Check this. Market approach, cost approach, and income approach. These are nothing but the popular valuation technique which we can use when quoted market price is not available. When the quoted market price is not available, we have to give the preferences. We have to use the valuation techniques on this manner. First the market approach, cost approach, and then income approach. Okay? Yes, sir. So here the right answer will be first option. 13th May option will be first. Okay, yes sir. Next one. Sir, which of the following is or are objectives of Ind AS 113? Ind AS 113, its objective is very clear. Sir, how to find out the fair value of any asset or liabilities? What are the disclosure requirements for that? How to find out the disclosure requirements and how to find out the fair market value. This is the main objective of this Ind AS 113. Okay, fine, sir. To set up a framework to specify the requirements of disclosure, so the answer will be both 1 and 2. Answer will be both 1 and 2. Okay, yes sir. So option C. Option C. Next one. Changes in accounting estimates results from. This is also a standard question from Ind AS 8 they have asked it. But the thing is, even if you don't know, you can still answer the question. Okay, so what they are trying to say is changes in accounting estimates result from, first thing, the new information. It can be from new developments also, and it can be not a correction of errors. If it is correction of errors, we have to do as per prior period errors ka standard. That treatment is little bit different. But here, changes in accounting estimate will be resulting from new information is also covered, new developments is also covered, and it should not be a correction of error. Therefore, all of this should be the right answer. So 15th ka option to D. 15th ka option D. Okay, sir. Next part. Mohini Limited have segments, namely X, Y, and Z. The total assets of the company are 10 crores. Total assets of the company are 10 crores. This is related to Ind AS 108. This is related to Ind AS 108 business segments. Okay, so total company ka assets to 10 crores. Segment X is having 2 crores. Segment Y is having 3 crores and segment Z is having 5 crores. The accountant have identified all the 3 segments are reportable segments. In this case, they are asking the question. See, let me open this part also from our concept book itself. This Ind AS 108 may, sir, what they will explain is, see, Ind AS 108 may what they will explain is, see, they will be giving some theoretical part which is not that much important from the exam perspective. What is important from exam perspective is this thing. Reportable segments, concept number 3. So here what they will be saying is, first you have to check the revenue of this particular segment. It should be more than or equal to 10% of combined revenue. First preference we have to give to the revenue of each segment. If it is more than 10% of the total revenue, then all the segments will be treated as reporting segments. Okay, sir. Second part though, we have to give importance to the profit or loss. We will be finding out absolute figures, whether it is loss also no problem, whether it is profit also no problem. We have to take profit or loss of each segment if it is more than or equal to 10% of the total profit or loss. That segment will become reportable segment. And third preference now we have to give to the assets of any particular segment. If it is more than 10%, then it will be treated as reportable segment. Okay, yes sir, what exactly you are trying to say, can you please summarize here? Yes, see, first preference you have to give to revenue. Second preference we have to give to profit or loss. Third preference we have to give to assets. Remember only one thing. So assume there are totally 5 segments. 5 segments ka you have to identify its revenue, profit and assets. Each segment ka revenue, if it is more than 10% of the total revenue, whatever the segments which are having more than 10% revenue, that will become reportable segments. Very, very simple. Here, that is revenue. Similarly, we will do for profit or loss also. Profit or loss. Don't take only profit. Profit or loss should be 10% or more than the total segment ka profit or loss. Then that will become reportable segment. Then which means we have to refer that. We have to consider that segment as a reportable. And last part of assets. Assets also. Just take the total assets. Calculate the 10%. If any segment ka assets is more than 10%, it will become reportable segment, otherwise not. Okay. Which means here if you observe, total assets are 10 crores. Calculate 10 crores into 10%, it will become 1 crore. So whatever the segments which are there, whose assets are more than 1 crore, it will become a reportable segment. Sir, here if you observe, check this part. Segment X is having 2 crores. Segment Y 3 and segment Z 5 crore. Sir, segment X is also having more than 1 CR. Y is also having more than 1 CR and Z is also having more than 1 CR, which means every segment ka assets are more than 10% of the reporting segment now, of the total segment now. Total assets. Therefore, X and Y and Z, everything is a reportable segment. Every segment is a reportable segment, and hence our option is this one. And hence our option is this. So let me change the question a little bit. So see, segment Z is only 0.5 crore and the segment Z is 7.5 crore. Segment Y is less than 1 crore. Therefore, it will not become a reportable segment. Very, very simple. Yes, sir. The next part. If total external revenue by operating segments constitutes a dash of the entity's revenue, additional operating segments. This point you have to remember. So segment ka sales will be external revenue, which means which is made to outside customers, and internal revenue also, which is nothing but made to internal segments. So here what you have to understand is, if whatever the reporting segments you have understood, you have to take the external revenue of those segments. If it is more than 75%, then it is fine. But if it is less than 75%, if it is less than 75%, you have to include additional segments also as reportable segments. Very simple. Check this part. This is also there in the concept book. If external revenue of all identified segments is less than 75% of external revenue of the entity, then additional segments should be identified as reportable. So what is the meaning of this? Let us try to understand. So see, Z is there. Okay, X, Y, Z. Assume these three are reportable segments, and another segment is also there, which is P. See, sir. X ka external sales is 5 lakh, Y ka external sales is 2 lakh, and Z ka external sales is 3 lakh. 5 plus 2 plus 3. But what have happened is, combined external revenue of the total entity is, assume it is 50 lakh rupees. Assume it is a 50 lakh rupees. Now what I have to do is, I have to calculate 75% of this 50 lakh rupees. 75% of this 50 lakh rupees, if I calculate, I will get 35. I have to take the external revenue of all these segments. Sir, assume these are there now, these have become reportable because of asset ka rule. Combined assets of entity, these three assets are more than 10%. Therefore, these three have become reportable. But now I have calculated the external revenue of the reportable segments, and I understood that whatever the segments which I have identified now, their revenue, external revenue is not more than 75%. It is less than 75%. Then what we have to do is, you have to include other segments also as reporting till its revenue exceeds 75%. Till its revenue exceeds 75%. Understood? Yes, sir. Please listen to the point once again. You just have to take the revenue, external revenue of the reporting segments. If it is more than 75% of the total, then it is fine. But if it is less than, then whatever you have did now, we have to include some other segments also as reporting segments. We have to include some other segments also as reporting segments. Okay? Fine, sir. Done. So here the option will be less than 75%. So 17 ka option is 1. Okay? Yes, sir. Next one. Chief operating decision maker identifies a function or designation or person or title. This is also relating to Ind AS 108 only. So, sir, here what they are trying to say is, chief operating decision maker is that a person who basically identifies a business, what is the reporting segment and all. Okay, majority of the cases, entity have to follow this threshold criteria. But sometimes what they will be doing is, they will be finding out some qualitative factors also, and then they will use those qualitative factors to identify whether a segment is a reportable segment or not. Understood? Yes. So here what they are trying to say is, Chief operating decision maker is not more of a designation. It is not like a CEO or CFO kind of a thing. It is not more like a designation. Rather, it is a function based qualification. Rather, it is a function based qualification. Okay? Yes, sir. So option will be function. This is also a little bit standard the question. Okay, but no problem. We can answer it. It is not that much difficult. Yes, sir. The next part. An operating segment is a component of an entity that engages in business activities from which it may earn revenues or may incur expenses, either of the above or 1 and 2. Okay, I think we have forgotten this 19th point. Let us quickly check this 19th point, guys. An operating segment is a component of an equity that engages in business activities from which it may earn revenue and may incur expenses. See, these segments, whatever we have identified now, those are nothing but those segments may it have the capability to earn independent revenue and it have the capability of incurring an independent expenditure also. Okay, so fine. So here the option will be may earn revenue and incur expense. Okay, so the right answer will be 19th May. Second option is the right. Okay, yes, sir. Next part. An operating segment is a component of an entity that engages in business activities from which it may earn revenue and may incur expenses. So right option will be D. Right option will be D. Okay, both 1 and 2. Fine. So the next part. Tax depreciation is accelerated. Tax depreciation is higher than the accounting depreciation. So now what the entity have to recognize? This is nothing but little bit of what should I say? Income taxes ka depreciation is what you have to understand. Okay, let us try to analyze this part. Just a moment. Oh, what have happened? Okay, fine, sir. Let us try to analyze this part. Sir, here what have happened is, guys, we all know that depreciation as per income tax and depreciation as per accounts, both will be different. Correct? Yes, sir. Both will be different. Okay, sir. Fine. Now what have happened is, sir, let us assume depreciation as per income tax is 10 lakh rupees. Depreciation as per accounts is only 8 lakh rupees. Depreciation as per income tax is 10 lakh rupees and depreciation as per accounts is 8 lakh rupees. Now, what is the problem here? Sir, as per our books of accounts, we will be calculating depreciation as per the rates given in respective schedule. As per Companies Act schedule, we will be calculating depreciation as per accounts. But sir, as per income tax, I think you guys have already remembered. Yes, sir. So as per our accounts, the depreciation is only 8 lakh rupees, but as per our income tax, so depreciation is 10 lakh rupees. Sir, how it will happen? This you have already know that. As per income tax, now rates are different. And there they will be following block-wise depreciation. But as per accounts, so we will be following individual asset-wise depreciation. Now the problem is, while calculating PGBP income as per income tax, we will be ignoring the depreciation as per accounts. And we will be taking only that depreciation which is relevant as per income tax. While calculating the PGBP income, whatever the depreciation I have calculated as per accounts is irrelevant for me. For me, only the thing which is relevant is depreciation as per income tax. Now comes the logic. Sir, as per my accounts, depreciation is only 8 lakhs. But as per IT, income tax depreciation is 10 lakh rupees. My point is, while calculating the taxable profit, not accounting profit, while calculating the taxable profit, let us assume, sir, my income is 50 lakh rupees. My net profit as per profit and loss, as per books of accounts, is 50 lakh rupees. Now the thing is, sir, what is my PGBP income? My PGBP income. Now I have to take the depreciation as per income tax, not accounts. Sir, but your net profit may already you have taken this accounts ka depreciation. So it is very, 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 very simple. So first I will be adding back this 8 lakh rupees and I will be deducting the depreciation as per income tax. Therefore, my PGBP income is 42 lakh. PGBP income is 42 lakh. Sorry, it is 48 lakh. 48 lakh. Now try to understand. Sir, as per income tax, my income is less. As per what should I say? Books of accounts, my income is more. As per my books of accounts, my income is more. But as per income tax, my income is less, which is 48 lakh only. Now try to understand. Whatever the depreciation is there, na, sir, what is correct? Whether accounts is correct or income tax is correct? Answer is both are correct. Answer is both are correct. Sir, but why my taxable income is different from the accounting profit? That is because of that difference is temporary, and that is because of the timing difference. The difference is there only because of the rates of depreciation. Nothing other than this. This difference will be eliminated. This difference will be eliminated. Sir, assume the cost of the asset is 40 lakh only. Second year, I will get 10 lakh rupees. Third year, I will get 10 lakh rupees. Fourth year also, I will get 10 lakh rupees. After 4 years, my asset ka value will be more. After 4 years, my asset ka value will become 0. Sir, but accounts mein, second year also I will get 8 lakh. Third year also I will get 8 lakh. Fourth year also I will get 8 lakh. And fifth year also I will get 8 lakh. Sir, but as per income tax, you will not get as per fifth year. Which means, try to understand. Anyways, whether you follow as per IT or accounts, both will become 0. But at different points of time. The reason for that difference is called as temporary difference, only because of timing difference. Only because of rate of depreciation, only the difference is there. Now let us try to understand. Sir, for 4 years, as per income tax, I will get the depreciation. But what about fifth year, sir? Fifth year may you have to pay more tax in the future, because as per income tax, asset of the value have already become 0 at the end of year 4. At the end of year 4, asset ka depreciation I have taken for all the 4 years and it have become 0 as per income tax. But as per accounts, you still have fifth year also. But as per accounts, it is there. As per income tax, you can't take the deduction in the fifth year also. Because of which you have to pay taxes in future. Listen only one thing. Sir, if I am paying taxes in the future, you have to create something which is called as deferred tax liability. Sir, in future, if I am getting deduction, then you have to create deferred tax asset. Another example also I will give, don't worry. Another example also let us try to take. In future, if I want to pay taxes, I have to create a deferred tax liability. In future, if I am getting deductions, I have to create a deferred tax asset. Sir, another example. Okay, no worries. See, check this part. Sir, as per IT, depreciation is 8 lakh rupees. But as per accounts, depreciation is 10 lakh rupees. Same asset ka value, 40 lakh only, let us take. Second year also, I will get 8 lakh rupees depreciation. Third year also, I will get 8 lakh rupees ka deduction as per income tax I am talking. Fourth year also, I will get, even fifth year also, I will get. Sir, but as per your accounts, na, 10 lakh, 10 lakh, 10 lakh. Sir, here what happened, you understood. Only for 4 years, I will get the deduction. Oh, but that is as per your books of accounts. But as per income tax, na, you will get deduction for 5 years, not 4 years. You will get a deduction for the 5 years and not the 4 years. Therefore, in future also you will get a deduction, because as per income tax, you have some value. So at the fifth year, you will definitely get the deduction. So sir, what we have to create? We have to create something called as a deferred tax asset. You have to create something called as deferred tax asset. Sir, how we will be doing? Let us try to understand this part also. See, every year P&L account may. On taxable income, what you have calculated as per income taxes, what is your income? On that you have to pay current tax, that is different. Current tax. Okay, assume same 40 lakh is there. But this 40 lakh may I have deducted 10 lakh rupees depreciation. So first this 40 lakh, I will add this 10 lakh and I will deduct this 8 lakh. So sir, mine, it will become 42 lakh. On this 42 lakh, I have to pay the taxes as per income tax. So now what have happened is, I have to assume the tax rate is 30%. So this difference is how much? This difference is 2 lakh. So on this 2 lakh, I will create 30%, and this 60,000 is nothing but my deferred tax asset. So assume for the coming years also same income is there. So second year also I will create 60,000 deferred tax asset. Third year also I will create 60,000 deferred tax asset. Last year also I will create 60,000 deferred tax asset. Sir, how much deferred tax asset you are having? DTA 2,40,000. In future, this I have to pay the tax. Now I will get the deduction. Fifth year May I will get the deduction. Now, so whatever this you have created, see, you just have to calculate, sir, 8 lakhs, but here it is 0. So 8 into 30% I have to do, and I will be getting 2,40,000 rupees. This 2,40,000 will be allowed as a deduction for me. Okay, in future. So to conclude, all these 4 years you have to create deferred tax asset, which means in future you will get deduction. In future, if you get deduction, deferred tax asset should be created. But here now, in future, I have to pay additional tax. Therefore, I have to create a deferred tax liability. Sir, how much? This difference, 2 lakh into 30%. Here also, 2 lakh into 30%. Assume the incomes are same. 2 lakh into 30%. Again, 2 lakh into 30%. But last year, I have to pay the tax, which is nothing but 8 lakh into 30%. I hope you have got the point. Okay, fine, sir. So here if you observe, what they are trying to say is, tax depreciation is accelerated. That is, tax depreciation is higher than accounting depreciation. Sir, if tax depreciation is more, I will get higher deduction at current, which means I will not be getting, in future, I will not be having deduction. Which means if I don't have deduction, I have to pay more tax in future. If you are paying more tax in future, you have to create a deferred tax liability. You have to create a deferred tax liability. Just refer to examples what we have discussed. Once again, you will exactly understood everything. Okay, if tax depreciation is more, we will fastly use the asset for income tax purpose, which means you will take more deductions earlier. In future, you will not be having deductions. Therefore, you have to pay the taxes. You have to pay the more taxes. In future, if I am paying more taxes, I will be creating deferred tax liability. I will be creating deferred tax liability. Okay? Yes, understood. Next part. An entity recognizes a liability of 100 rupees for gratuity and leave encashment expenses by creating a provision. For tax purposes, such amount will not be deductible until the entity pays the same. Tax rate is 25%. The entity should dash. Try to understand. As per accounts, they have created one provision. But income tax is saying, if you remember, there are some sections which is called as section 43B, where they will say that, sir, some payments will be allowed as deduction only if they are actually paid. Another set of deductions are nothing but 40A clause 7, which is nothing but gratuity related point. Sir, if any provision for gratuity is made now, you will not get deduction. Deduction will be allowed only if it is actually paid. Which means income tax is saying, Arey Baba, no, you will not be getting deduction right now. Sir, when will I get the deduction? In future, you will get the deduction when you actually have made the payment. Oh, in future, you will get the deduction only when you have actually made the payment. Okay, sir. Since in future, if you make the payment, you will get deduction. In future, if I get a deduction, sir, what I have to do? You have to create the deferred tax asset. You have to create the deferred tax assets. Or on what amount I have to create? On the difference amount only you have to create. So the tax rate they have given 25%. Sir, as per accounts, my provision ka value is 100 rupees, but income tax may the value is 0. You will get deduction only in future. Therefore, sir, what I have to do is 100 is there as per your books minus income tax have when no value is there into 25%. If you do, I will be getting 25, and this 25 is nothing but deferred tax asset. This 25 is nothing but deferred tax asset. ठीक है? Okay. Next part. Borrowing costs directly attributable to dash of a qualifying asset should be capitalized as part of the cost of the asset. This is related to Ind AS 23, which is borrowing cost. Borrowing cost is nothing but we already know that, sir, if any qualifying asset is there, whatever the interest cost which is attributable to that qualifying asset, whether it can be purchase or whether it can be construction or whether it can be production, anything we can take. It should be a qualifying asset. That should be the case. Sir, what is the meaning of qualifying asset? Qualifying asset is nothing but that asset which takes substantial period of time to get ready to use. Okay, fine, sir. So this 23 option is nothing but acquisition is also related, construction is also included, and production is also included. So all of this will become the correct answer here. Okay, fine, sir. The next part. Hari Limited have purchased a ship during the year on deferred payments basis, payable after next 10 years. This ship is what? Guys, you have to understand, qualifying asset means it should take a substantial period of time. If you directly purchase one asset and here just you are making the payment later, ship will be ready to use only after you have purchased. After you have purchased, immediately the ship will become yours and it is ready to use. But they are only saying only payment will be made after 10 years. That doesn't make the asset as a qualifying asset. They are not saying it is taking substantial period to get ready to use. They are saying it is taking substantial time to make the payment. That is not a factor to consider whether it is a qualifying asset or not. Therefore, here in this case, it is not a qualifying asset as per Ind AS 23. It is not a qualifying asset as per Ind AS 23 will be our answer. So 24 option is 2. Okay, fine, sir. Next part. Dash are money held and assets liable to be received or paid in fixed or determinable amount of money. Guys, this is the meaning of monetary items. This is the meaning of monetary items. Sir, what is the meaning of monetary items? It is nothing but either money or any liabilities, whether it is whatever the amount which you are paying if it is fixed, or whether whatever the amount which you are receiving if it is fixed or determinable, it can be called as a monetary item. For example, debtors. We can find out how much amount we will be getting from the asset. It will become monetary items. Creditors also, if you observe, sir, how much amount I am paying to that liability, that will become fixed or determinable, which means I can find out easily. It will become a monetary amount. It will become a monetary amount. Right answer as per this. 25th is second option will become the right option. Monetary items. Okay, sir. Next part, the major three approaches to valuation of the shares. The major three approaches to valuation of the shares is very simple: income, net assets, and market approach. So both. All of this will become the answer. So which means 26th ka option is 4. 26th ka option 4. Okay, sir. Next part. The ways of determining the value of the goodwill using the capitalization approach. We already know that, sir, capitalization, so we can do for average profits also and we can do for super profits also. Therefore, the option will be both 1 and 2. Option will be both 1 and 2. Okay. 27 option will be both 1 and 2. Next part, the major basis of asset valuation for a going concern. This point I think we have already repeated MCQ. This is the capitalization of average profit, super. Okay, this is book value, net replacement value, net realizable value, and all of this will become my answer. Okay. Yes. Okay. So next part, 29th one, if you observe, they have given capital employed to 55 lakh. Annual average profits are 57 lakhs. Normal rate of return to 12%. Value of the goodwill on the basis of capitalization of super profits. They are asking you to calculate. They are asking me to calculate value of goodwill on the basis of capitalization of super profits will be how much. Okay. If you observe, let me just open that part for you. This one, guys. Value of the goodwill, capitalization method. We have multiple formulas. So what is the super profit ka capitalization is very simple. What we have to do is goodwill will be value of the firm minus net assets you have to calculate. But if it is super profit capitalization method, it is very simple. We just have to find out super profit by normal rate of return. Our answer will be, you just have to calculate the super profit divided by normal rate of return. So, sir, now what we'll be doing is, if I observe here, So here they have given the capital employed is 255 lakh. Average profits are 57 lakh they have given. Normal rate of return to 12%, and they are asking me to calculate value of the goodwill on the basis of capitalization of super profit. So first let me find out the super profit here. Okay, yes sir. Sir, super profit is how much? 57 is the normal profit minus capital employed into normal rate of return. If I do, I will get 30.6. I will get 30.6. Therefore, 26.54 is nothing but 26.4 is nothing but my super profits, and the formula of capitalization is very simple. Divide by 12%. If I do, 220 lakhs I will get. Okay, this 26.4 super profit divided by normal rate of return I have to do. 26.4 divided by normal rate of return. So how much? 220 lakhs will be your answer. How much, sir? 220 lakh will be your answer. Let me just check the answer also, whether it is correct or not. Sorry guys, mistake. Okay, fine. So 30th, 29th option if I'm not wrong. Yes, 220 lakh is the correct one. 30th question. A firm uses goodwill under capitalization of profits method. Average profits they have given 1 lakh rupees, that is before tax. Capital employed is 4 lakh 80,000. Normal rate of return to 12%. Tax rate they have given 28% on average, and you just have to find out the valuation of the goodwill based on capitalization of average profits. So here what is the formula? Very simple guys. Okay. The formula will be average profit. See, so where is the formula? Just go here. The formula will be said future maintainable profits divided by normal rate of return. You have to find out, and from this you have to deduct capital employed. Okay, fine sir. This future maintainable profits, so after tax we have to take, sir. 1 lakh is there. 1 lakh after tax, if I calculate, 72,000 will be the answer. How much, sir? 72,000 will be the answer. I just have to calculate 72,000 divided by 12%, and from this I have to deduct my, what should I say, capital employed. Then I will be getting the formula. I will get 1,20,000 as goodwill ka value, and therefore 30th option 1 become the correct answer. 30th May option 1 will become the correct answer. Okay, fine. Next one. The Indian accounting standards are relevant for recognition, measurement, and disclosure of financial instruments. Sir, financial instruments is a comprehensive standard, and we are basically having 3 standards. Ind AS 32 is also there, 107 is also there, 109 is also there. 3 deals with financial instruments only. One with presentation, one with disclosure, and one with financial instruments. 109 may financial assets, most of the financial assets are discussed along with their respective disclosure requirements also. Okay, so to conclude, all these 3 standards will become part of financial instruments. So the right answer will be all of this. So the right answer will be all of these. Okay, sir. Next part, 32. And DAS is any contract that evidences the residual interest in assets of an entity after deducting all its liabilities. We already know that financial instrument definition is there. That is nothing but financial contract will be there. Okay, one party will be getting the financial asset and another party will be getting the financial liability, and that is a contract which is called as financial instrument. Okay, that is different. Putable instrument is also an altogether a different item. It is related to some derivative related asset is being explained there. But the thing is, when they are talking about residual interest after deducting all its liabilities, whatever the value which you will be getting, that is called as an equity instrument ka portion. So it is nothing but all assets of entity after deducting any of its liabilities. If you do, you will be getting finally equity ka value. So here 32 ka option will be 32 ka option will be 1, sir. Okay, sir. Next part. Ind AS 109 deals with, we have already said that recognition and measurement of financial instruments and the hedge accounting is also being described here. Presentation of financial statements, no. Disclosure of financial statements also, see. These 3 are correct only, but which option is most correct, we have to pick that option. Recognition and measurement of financial instruments along with hedge accounting has been discussed. but in days 32 May, some disclosures will be there along with some financial liability ka discussion. In days 107 May, most of the disclosures are there. Okay, so to conclude here, out of these three options, the best option will be first. So 109 May presentation and even hedge accounting concept is also being described in Ind AS 109. So my option will be this one. Okay, fine, sir. The next part. Non-performing asset in case of lease, rental, and hire purchase assets will be. See, this no need to by heart, guys. Just to check this part. Okay, this is not that much important. So here, what they have taken is there is no need for us to remember all these dates. Okay, but as of now, if it is overdue for more than 3 months as on 31st March 2018 onwards, from 31st March 2018, you have to check if it is a hire purchase asset or lease asset. It will become NPA if it is overdue for more than 3 months. This you have to remember. These are transitional provisions. Before it is there, you can just remember this part. But these are also correct only. From 1st March 2016, it is overdue for 9 months, and next 1 year though, it is overdue for 6 months. And as of now, if it is overdue for 3 months or more, if it is overdue for 3 months, it will become an NPA. So, strictly speaking, all are correct only. But my sincere advice is no need to by heart this type of point. Okay, you just have to remember this part. But in case if they have given this type of MCQ, you are totally fine. The term public funds includes, sir, public funds may, if you observe, debentures also will be raised from the public only, and public deposits also will be directly raised from the public, and even bank finance also. Bank is also a kind of public only now. So all of this will become public fund ka valuation. Okay. So strictly speaking, here also all of this I can write, and even here also all of this I can write. Okay, fine. So the next part. Ind AS are applicable to NBFCs on and from. This is a date which you have to remember. Very, 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 very important date according to me. For NBFCs, Ind AS are going to be applicable from 1st April 2019. This you have to remember, guys. 1st April 2018. Okay, sir. The next part though. All NBFCs non-deposit which have an asset size of 500 crore or more, which are nothing but systemically important, and above and all NBFCs D, which means NBFCs deposit taking shall maintain a tier 1 capital of 10% is the answer. Minimum tier 1 capital of how much they have to maintain, sir? They have to maintain the 10%. This is also important. We have not discussed this in class because NBFCs chapter is this much. Whatever important for problem solving, we have already covered them. But some points are a little bit important for MCQs also. Those I have been discussing here only. Okay, fine. So, next part. From the following particulars, you are required to determine the value of the goodwill. They have given super profit ka value 4,50,000. Normal rate they have given 12%. Present value of annuity also they have given. Okay, which means they are asking us to calculate the goodwill value using annuity method. It is very simple. You just have to multiply the super profit, that is 450,000 into, they are very kind, they have directly given the annuity factor also, which is 3.0374. If I just multiply, I will get the answer 1366,830. So the option 1 will be the correct answer. 1366,830. I will be getting the first value. Okay, yes sir. Super profit equals to average future maintainable profits minus normal profit. Therefore, this option will be the correct answer. Next one, the major basis of asset valuation. Repeated. This is again repeated. Book value, net replacement, net realizable value. All of this will become my value. Okay. Yes, sir. This 41 question is there now. So what I want you guys to do, this question is little bit incomplete, but what we have did is this type of exact copy paste question we have already seen in our financial instruments ka chapter. Financial instruments ka chapter में very limited questions we have selected. I think this question too I have given in even in super 55 questions also. So my sincere request, check that. Answer is also, I remember the answer will be coming to 41.5 lakh. Just check our material. Financial instruments ka chapter mein this question is already there. So I prefer you guys to refer that question. Okay, this question is not that much perfectly drafted. Little bit incomplete this question is. Okay, so my sincere request is you just have to check that part. Understood, sir. The next part. The Indian accounting standards relevant for recognition, measurement, and disclosure of financial instruments. Again, they have given 32, 107, and 109. So I will be putting all of this as the correct answer. Next part, sir. Financial assets are nothing but. This definition we have already know that. Sir, cash will be always a financial asset. Any equity instrument of another entity, which means if I have invested in equity shares of Geo Limited, that will become financial asset. Third part, though, any contractual right to receive the cash, that will be also a financial asset. So answer will be all of this. Answer will be all of this. Okay. Next part, sir. Ind AS 109. Financial instruments classified as financial assets and financial liabilities into the following categories. We all know that. Amortized cost, FVTPL, FVTOCI. Therefore, all of these will become the categories. Okay, yes, sir. Next one. Ind AS 109 deals with, I think, similar question. We have already checked this. So, recognition and measurement of financial instruments and hedge accounting is being covered in Ind AS 109. Therefore, option 1 will become the correct answer. Repeated question. And DAS is a contract. Any evidence is residual interest. Residual interest means it is equity instrument only. This you have to remember. Residual means after paying off all your liabilities from the assets, whatever the value you are getting, that will become equity ka portion. So answer will be equity instrument here. Okay, sir. Sir, fair value is the amount for an asset which could be exchanged or for a liability settled between knowledgeable willing parties in an fair transaction, influencer transaction, or arm's length transaction, or all of these. You have to check this part. It is very, 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 very simple. If the parties are influenced, if the parties are related, it will not give you a fair price. Correct? If me and my relative have a transaction, whatever the price which we have entered now, that will not become fair value, because of my relation, the price will be, what should I say, compromised. Okay, which means we cannot take if the parties are influenced or related. Fair transaction is also not the actual word which they have been used in the standard. In the standard, what they have preferred is they have preferred arm's length transaction. So here what we have to do is fair value is nothing but whatever the amount which can be exchanged for an asset or whatever the amount which can be settled for a liability between knowledgeable parties which are willing to perform an arm's length transaction. Therefore, the value will be this. Therefore, the value will be arm's length transaction. By whatever the value is there, that will become the fair value ka answer. So I think the option C have to be the correct in this case. Okay? Yes, sir. Next part. A Limited acquires 80% of B Limited for 12,80,000 paid by equity. I think. See, if you read the solution after completion of the questions, they have given the answers. In the answer ka key, they have given clearly the question. Let me just show you what I am trying to say. 48, I guess. See. Here they have given the question. Consideration, they have given 12,80,000. 80% is the stake which they have purchased. If 80% A Limited have acquired, obviously NCI ka value is 20%. But they have given fair value of B at the time of acquisition is 9 lakh rupees. Out of this 9 lakh, 20% belongs to NCI. They have proven that NCI is measured at Pasina is what they have given down, which means 12,80,000 plus NCI ka value 9 lakh into 20%. If I do, I will get 1,80,000 minus what are the net assets? Net assets to 9 lakh rupees. I will get the goodwill. So 1280 plus 180 minus 9 lakh. If I do, I will get the goodwill ka value as 5,60,000. I will get goodwill ka value as 5,60,000. Let us check the answer. Yes, 5,60,000 is the goodwill ka value. Therefore, option D will be the correct answer. Yes, sir. This question also similarly, guys. 49th question also similarly. It is missing in the question. If you check the answer, you will find out. A Limited acquires 80% of B Limited for 10 lakh rupees. NCI ka value is 20%. So 20% of 9 lakh, if I do, I will get 1,80,000 because this 9 lakh is nothing but Pasina. I mean NCI, fair assets, net assets ka value. Out of this, 20% belongs to NCI. So if I find out the goodwill, my goodwill will be 2,80,000. My goodwill will be 2,80,000, which means goodwill 2,80,000 becomes option number 2. Just check the solution ka part, you will find out the question. Okay, fine, sir. 50th question. Sir, A Limited acquired 80% for 600 lakhs. Identifiable assets are measured at 925 lakh and liabilities at 150 lakh. Sir, what are my net assets? If you do 925 minus 150, if you do, you will get 775 lakh as net assets. $775 lakh as net assets. So they have only clearly given fair value of NCI is 90 lakh rupees. So if fair value of NCI is 90 lakh rupees, consideration is 600 lakh. 600 plus 90 minus 775 is nothing but net assets. Whatever the difference which you got, I have got the credit balance, negative balance, which means it will become my GBP, which is nothing but gain on bargain purchase. So how much? I think 85 lakh. Therefore, option B should be the correct answer. Option B should be the correct answer. Okay, sir. Next part. 51 question. A Limited acquired B Limited for 12,60,000. Fair value of B's net assets is how much? Of 11,80,000. Sir, so my goodwill is how much? Very simple. Here there is no NCI. So 12,60,000 minus 11,80,000 if I do. 80 will become my goodwill. 80 will become my goodwill ka value. Understood? Yes, sir. Next part, 53rd question. If you observe, I think this is there. 52. Yes. Q Limited acquired 60% interest in R Limited. Q Limited paid 900 lakhs. Fair value of R Limited is 2000 lakhs and fair value of the liabilities is 1000 lakh. Sir, what are my net assets? Guys, net assets is nothing but 2000 minus liabilities ka value 1000. Therefore, 1000 lakh will be my net assets. Sir, 60% belongs to Q, which means 40% belongs to NCI. NCI, they have clearly given to evaluate proportionate net assets, which means 1000 into 40%. If I do, 400 will become NCI ka value. 900 is the consideration paid and 1000 will become the net assets. Therefore, 300 lakh will be the goodwill. 300 lakh will be the goodwill. Understood. 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 Sir, this 53rd question is incomplete. They have not given whether to calculate the goodwill or whether to calculate the NCI and all. So here we cannot calculate the things. Okay, I can write the question as incomplete. But if you observe, sir, consideration they have given is how much? 60,000 into 25 they have given, which means 15 lakh is the consideration which they have paid. 15 lakh is the consideration they have been paid. And they have given the fair value of the assets is 13 lakh rupees. And they have given the fair value of the assets is how much, sir? 13 lakh rupees, which means in the question there is no NCI. So I think the goodwill ka value will be 2 lakhs. I think the goodwill ka value will be 2 lakhs. Okay, but unfortunately in the answer they have given this 15 lakh rupees as the question, which means I think they may decided to give like this. Sir, what is the value of the consideration? That's what I'm saying. This question may what you have to find is irrelevant. Sir, if they have asked you to find out the goodwill, answer will be 2 lakh. If they want you to find out the consideration, answer will be 15 lakh rupees. Sir, have you got 60,000 shares into 25 rupees is the value. We have to take the fair value for the purpose of calculating consideration. I hope you have remembered the standard 103 ka discussion which we have been doing from the past few days. Okay? Yes, sir. Next part, 54. As per Ind AS 103, while accounting and reporting for business combination, goodwill is to be calculated as very simple consideration plus NCI ka value minus net assets we have to do. So I think option 1 should be the correct answer. Take yes, sir. So next part, this is a little bit important, so we have to check this part. On 1st April 2020, Gold Limited acquired 75% share of Coal Limited at 10,80,000. When its fair value of its assets were 10 lakh rupees. During this period, Coal Limited made a total comprehensive income of 2 lakh rupees. This is clearly post-acquisition, guys. On 31st March 2023, Gold Limited purchased 15% holding from outsiders. They are asking you to calculate NCI at proportionate net asset value. Very, very simple. Very simple. Sir, first of all, what is the value of the total? At the time of purchase, net assets are 10 lakh rupees. But afterwards, it have made a profit of 2 lakh, which means its profit is increased. Therefore, sir, the total net assets till 31st March 2023 are how much, sir? Sir, 10 lakh earlier, plus after that I have got the profit now, which means 12 lakh will be the value of the net assets on the date of acquisition. Sir, earlier it is having 75%. Now it have purchased balance 15% also, sir. Earlier it is having 75%. Now it is purchased balance 15% also, which means now 90% belongs to NCI only. Sorry, 90% belongs to gold only. Sir, what about balance 10%? Balance 10% is belongs to this person's NCI. Now what they are asking is, sir, what is the NCI value at a proportionate net asset value? How much I have purchased? You have purchased 15%. Sir, this 12 lakh is the total value of the net assets. If I do into 15 percentage, I will get whatever the NCI carrying amount which I have purchased. 12 into 15%, which I do, I will be getting 1,80,000. This, check the consolidated notes I have already written. If I have purchased additional stake after it becomes subsidiary, I understood that my NCI value will be decreased. Debit I have to give to NCI at the carrying value of the investment. Sir, carrying value as in whatever 15% is there now. I mean, the current value is 12 lakh rupees. So out of this 12 lakh, 15% is the NCI which I have purchased. 1,80,000 should be the value. They are asking you to calculate NCI at proportionate net asset value. Therefore, it should be 1,80,000. I think option 1 should be the correct answer. Option 1 should be correct answer. Okay, sir. Next part. Same to same question, but the answer is how much gain or loss should be credited or debited to equity. Sir, very simple. How much I have purchased? 15% I have purchased. Sir, 15% means what is the value? 1,80,000 will be the value. Value is 180, but I have paid 2,20,000. So it should be 40,000 loss for me. 40,000 loss for me. Sir, can you tell me the entry? Very simple. Sir, because of which NCI ka value is reduced. So NCI ka value is 1,80,000, which is reduced. To bank, I will write how much I have paid. 2,20,000 I have paid. To bank, I will write 2,20,000. Okay. So here, if you observe, the difference is there, sir. The difference will be transferred to consolidated P&L account or consolidated equity. Anything we can pass. So the value will be 40,000. Value will be 40,000. Okay, sir. Understood, sir. So loss of 40,000 should be booked, which means it is here. Loss of 40,000. Okay, sir. Understood, sir. So another question. Quickly move to the part 57th question. 57th question, guys. This kind of a question also, exactly similar question which we have been already discussed in financial instruments ka chapter. Financial instruments ka chapter में already similar question we have discussed. Okay, let me just show you the question. 1 second. 1 second, guys. Let me open the question first. I think it is in business combination. My bad. It is in business combination. Just a minute. This question, guys. See, DE Limited has acquired 100% of the equity question. Same to same question. Total value will become 12.1 lakh. So same copy paste question. So I'm not discussing it further. Okay. 12.1 lakh. Okay. Understood. Sir, 58th question. Same to same copy paste question we have already discussed in consolidated financial statements. Sorry, this question is also there in business combination only, which is relating to step up acquisition ka question. Step up acquisition, same to same copy paste question we have already discussed. So I'm not discussing this question also. Okay, please refer to our question which we have been discussed. Very, very simple question, guys. Okay, fine. Okay, so next question. On 1st Jan, M Limited acquires 80% of equity by issue of equity shares of paid up is irrelevant. Market value is the key. 480 lakh is the market value. They have given identifiable assets are measured at 760 lakhs and liabilities are measured at 120 lakhs. Compute NCI if measured at proportionate net asset. They are asking only NCI. Very easiest. Which means, sir, 760 is the valuation of assets minus 125 do, you will get 640 as the total assets. 640 into, since they have acquired 80%, 20% will become my NCI. So 640 into 20% if I do, I will get 128 lakh as NCI value, and therefore C should be the correct answer. Therefore, C should be the correct answer. Okay? Yes, sir. Next one. First Jan, same question, but this time they are asking you to calculate the gain on bargain purchase. Little bit different figures. Market value is 120 lakh. This will be our consideration. So take consideration plus we have to add NCI ka value. At proportionate net assets is what they have given. Therefore, 190 minus 30 if I do, I will get 160 lakh into 20%. Then I will get NCI ka value as 32. So 120 is the consideration. 32 is NCI minus net assets 160. If I do, I will be getting GBP ka value. I will be getting gain on bargain purchase, which is nothing but 8 lakh. Which is nothing but 8 lakh. Which is nothing but 8 lakh. Sorry guys, I think there is some disturbance. Okay, fine. 8 lakh is the value. So next, 61 if you observe. 80% for 12 lakh 80. Fair value is 14 lakh 80,000. Non-controlling interests are recognized at fair value. Compute NCI. Very simple. So see, 12 lakh 80,000 is consideration. Plus NCI ka value I have to add. 14 lakh 80,000 into 20% if I add, I will get 2,96,000. Or they're asking only to calculate NCI. So 2,96,000 is the value of the NCI. Let me just check the value. 2,96,000 is NCI value, but I think in the option they have forgot to give that part. So I think it is incorrect what they have given. So whatever the value which they have given is 3,20,000, it is wrong. Oh, they are asking us to calculate. I think it is missing in the question. Okay. NCI are recognized at fair value is what they have said. Okay, this is fair value guys, not Pasina method. Sir, how fair value will be calculated? Very simple. Sir, 80% they have purchased at 12,80,000. Sir, what for 20%? Unitary method we have to do. Sir, what is the meaning of unitary method? Very simple. 12,80,000 divided by 80% into 20%. We get, so 1280 divided by 80 into 20. So 3,20,000 will be the answer. So this 3,20,000 will become the value. 3,20,000. Okay. Yes, sir. So next part, 62nd question. Pooling of interest method is considered to involve which of the following? Very simple, sir. Pooling of interest method is there now. Sir, that will be applicable when the assets and liabilities of the combined entity were reflected at their carrying amounts. We already know that. Sir, this pooling of interest method is applicable when there is common control transaction. If there is any common control transaction, we have to give our preference to the pooling of interest method. So that the pooling of interest method may, what are the things which I have to remember? Very simple. Ignore fair values. Everything will be reflected at carrying amounts. No adjustments to made reflect to fair values or recognize any assets or liabilities. So this is wrong. Net realizable value pay will not do anything guys. Total bakwas. So this and this. So both 1 and 3 will become the correct answer in this 62nd MCQ. Okay, sir. Third part. 63 May. How is NCI shown in the financial statements of the acquired at a time of business combination? Sir, NCI should be shown as a separate line item in the equity. Separate line item in the equity. Therefore, the option will be 2 will become the correct answer. Because if you observe, it is shown as a liability. No, it is not outside a liability. It is equity part. It is not shown in balance sheet. It is also wrong. Now, NCI is not recognized. It is also wrong. So the answer will be it is shown as an equity method. Next part. As per Ind AS 103, accounting and reporting for business combination is done under. Normal business combination prescribes two types of methods. acquisition method and pooling of interest method. Acquisition of method will be applicable normal business combination पे acquisition method only you have to apply, but if it is a common control transaction then only we will be applying pooling of interest method. Therefore 64 पे normal सा business combination transaction we have to follow acquisition method only. We have to follow acquisition method only. Okay sir, next part. When after business combination acquiry ceases to exist, it is to be recorded in the books of dash once it only. See sir, here what have happened is A Limited, B Limited. A Limited have directly acquired the net assets of B Limited. After acquisition, this is not there. After acquisition, B Limited is not there. Therefore, there is no need for you to prepare consolidated financial statements. This I have explained in starting of the business combination chapter. Sometimes the companies can acquire only shares of the acquiring company, whereas sometimes they will acquire not shares, they will directly acquire the net assets of the company. After acquisition, this company itself will not be there. Therefore, CFS cannot be prepared. So, when after business combination acquiry ceases to exist, it is to be recorded in the books of acquirer only in single set. That is also in its standalone accounts only you have to recognize. So, the option will be acquirer. Okay, it is not one or two. No, business combination accounting have to be definitely done in the books of acquirer only. Therefore, option 65 may 1 will become the correct option. Okay, 65 may option number 1. Next one. 66. Ind AS 103 have a wider scope than if you observe. If you observe, AS 14 is nothing but one standard wherein you will learn amalgamations at interlevel, CA interlevel. So AS 14 may they are having only limited scope of accounting, but in AS 103 may we have reverse acquisitions also, common control transactions also, multiple things are there, demergers also, multiple things are there. It is having a wider scope than AS 14 is the correct answer. Okay, so 66 ka option 2 will become the correct answer. 67. At what value is NCI recorded in the books of the acquiree at the time of a business combination transaction under Ind AS 103? Sir, what they are talking? NCI can be either recognized at fair value or it can be either recognized at proportionate value of identified net assets. So, sir, whether this or this or this, it is not recognized, it is not correct. This is also, they are saying, it is recognized at fair. This is also correct. This is also correct. Even this is also correct. Either fair value or proportionate net assets. If you observe out of these three, this is the most correct answer. So we have to select option number 4. We have to select option number 4. Okay, sir. Very another important MCQ, this part. Consolidated financial statements are required to be prepared by an Ind AS complied company if it holds shares in the investee company. We have already know that 3 types of consolidation will be done. 2 types basically. First one though, in case of subsidiary also we will be doing one consolidation. Second one though, equity method ka associate wala consolidation also we will be doing, and in case of joint ventures also. In case of joint ventures also you will be performing consolidation. As per 110, whatever the consolidation which we have been learnt in detail, that will be applicable. Sir, but in days 28 May, we have 2 methods. I mean, in 2 cases, you will be doing this consolidation. This is not called as line-to-line consolidation. If you remember, in last part of the consolidation standard, I have explained this part. Everything will be adjusted in the carrying amount of the investment only. So, what we have to understand is these 2 will be prepared in case of equity method. These 2 are called as equity method ka consolidation, whereas this will become line to line consolidation, which we have been learned in detail. Problems are also asked on that basis only. Problems are also asked on that basis only. Therefore, all of this will be the correct answer here. Okay. Yes, sir. Next one. DAS standard requires when CFS are prepared, the investor company shall also prepare individual statements also, which are named as separate financial statements. That is given in Ind AS 27. Okay, important. Ind AS 28 में consolidated financial statements as per equity method. This line to line consolidation, this 112 may they have given separate disclosures. But this 27 may they will say that you have to prepare separate financial statements. Very, 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 very important MCQ. Consolidation pay, whatever MCQs are there, all MCQs are very, 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 very crucial and very, 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 very important. An investment entity is an entity. An investment entity is an entity that, first part, for it obtains funds from one or more investors for the purpose of providing those investors with investment management services. Investment entity is nothing but it will collect money from many investors and it will invest in such entities which will give the whole purpose of that investment is for capital appreciation or for earning investment income is nothing but dividend income or interest income, or both. The purpose of that investment is very clear. It is only for the purpose of getting capital appreciation or investment income or both. Next part 2 measures and evaluates the performance of substantially all of its investments on a fair value basis. Sir, how I have to choose those values is totally dependent upon fair value basis, or even if you follow cost basis also. To conclude, investment entity is nothing but, sir, I will be collecting amounts from investors and I will be pooling such investments and I will be investing in any entity. Okay, this is the whole purpose of an investment entity. Okay, sir, understood. Now the thing is, the purpose of me investing in another entities is only to get the capital appreciation or returns. That's it. Returns means dividend income, dividend or interest or whatever it is, only for that purpose. And second thing, though, I have to measure the investment on fair value basis. If I follow all these methods, it is exempted from preparing consolidated financial statements. That is covered in exemption, but that is useless theory. No need to worry about that part. Okay, fine, sir. So all of this will be the answer in this 70th MCQ. Okay, so 70th MCQ may all of this will be the correct option. Okay, sir. Next comes 71. Sir, 71 में Ind AS 103 states that the acquirer obtaining control over acquiring recognizes and measures in its consolidated financial statements at the acquisition date. At the acquisition date. Sir, this Ind AS 103 जो है ना, Ind AS 103 में, sir, what they are trying to say is, we all know that in the CFS, identifiable assets will be recorded at fair value. Okay, it is correct. NCI should be there, which should be recorded either at fair value or at proportionate value. This is also fine. And third one, jo hai na, goodwill acquired either in the business combination or gain on bargain purchase also should be recognized. Goodwill or GBP will be recognized. NCI at fair value or proportionate value, both will also be recognized. And identifiable assets should be recognized at fair value. So all of these should be the correct answer. So 71 ka option will be 4. 71 का option will be 4, sir. Fine, sir. Next part. Ind AS 112, disclosure of interest in another entity. An entity shall disclose the information and significant judgments and assumptions it has made in determining whether it is following control over another entity, or whether it is having joint control over another entity, or whether it is having significant influence, or whether it is having the type of arrangement, whether it is a joint operation or a joint venture. Everything is a disclosure standard. Even if you don't know anything, still if you read this, you will understand. Sir, if it is a joint arrangement, you just have to mention about that. If any entity is having significant influence, you just have to mention the shareholding percentage and all. Whatever the judgment which the entity have used in finding out whether it is having significant influence or not, everything have to be disclosed in as per Ind AS 112. As per Ind AS 112. Yes, sir, we have understood the part. Next part of 73rd. Important. 73rd may what they will be saying is, so a DAS is the contractually agreed sharing of control and arrangement which exists only when decisions about the activities require the unanimous consent of the parties sharing the control. Very simple. Joint control will be the answer. Joint control will be the answer. Okay. Joint arrangement where we are having multiple options, whether it can be a joint operation or whether it can be a joint venture. Okay. This we have already covered here also. And here also what they will be saying is that joint control is nothing but contractually agreed sharing of control between the parties. This exists only when about relevant activities require the unanimous assent of the parties sharing the control. So here the option will be joint control. And if you observe here, joint arrangements may two types may you can form, whether it can be a joint operation or whether it can be a joint venture. So here the option will be joint control and here the option will be joint operation. DAS is a method of accounting whereby investment is recognized at cost and adjusted there for the post-acquisition change in the investor's share of his investee's assets. This is nothing but equity method of consolidation. In days 28, if you observe, there whatever the changes in post-acquisition will be done through this investment only. So which makes 75th option as first. Which of the following is not a type of a joint arrangement recognized under Ind AS 111? Ind AS 111 may check this part. Joint contribution entity, this is not there. Joint control is there, operation is there, joint venture is also there, but joint contribution entity is not there, guys. So this should be ignored. How is the investor's share of profit or loss from a joint venture recognized? Guys, it is very simple. As a part of equity only, you will be writing. Post-acquisition share, that will be recognized as a part of equity only. That will be directly credited to P&L account. Okay. Expert. A dash is an entity of which the investor is having an significant influence. Very simple. Associate. Associate is an entity wherein one entity is having significant influence. 78 ka option to 1. Okay. Now come to theory chapters, guys. First part, to the three pillars of sustainability are referred as. The three pillars of sustainability are referred as. We all know that people is there, planet is there, profit is there. People, planet, profit. People, plant, profit is not correct. People, planet, profit. People, planet, profit. Okay, you have to remember the order also, guys. People, profit, planet, planet, people, profit, and people, planet, profit. Very important. You have to be very careful in this theoretical part, especially. Okay, so some students, this though they can eliminate directly, but here though, we may not remember the order, but you have to remember people, planet, profit. Okay, so I think the option should be 79, though second option should be their people, planet, profit. Yes, it is. Next part, XBRL reporting related question. They have given this also, they have asked in recent developments ka chapter. Okay, so whether we have to remember or whether we have to by heart all these forms, the answer is no. But whatever MCQs they have given in our this addendum MCQ bank pay, whatever MCQs they have given, we will be including that part. We will be including that part. So here the option should be CRA4. Here the option should be CRA4. Okay, fine sir, CRA4 should be the answer. Yes sir, we have understood. So 80 option to C. Just try to remember. Don't take much tension. If you remember, fine. Otherwise also still it is totally fine. CRA4, XBRL. So what the thing is, basically, whatever the company is there, it have to furnish this. It have to furnish this is an e-form which should be furnished by the companies which are following XBRL reporting. Okay, fine sir. Next part. External benefits of the sustainability reporting include, guys, this question is also there. I have marked also this as an important question. Okay, so here if you observe, sir, brand reputation will be increased definitely, and enhanced perception of organization value also will be increased, and even negative impact on the society also will be reduced. So the right answer will be all of the above. The answer will be all of the above. Next part, in 4P bottom line reporting. In 4P bottom line reporting, what they are trying to say is, sir, bottom line relate the business with happiness of the stakeholders. Bottom line reporting dash relate business with the happiness of the stakeholders. This also you have to remember the order, guys. Here also you have to remember which things are, we have to remember the order. Stakeholders is the last, which means we will be considering even the spiritual performance of the stakeholders also, correct? So it will be the last portion. And fourth P stands for spiritual happiness of the stakeholders. Okay, fine, sir. Next part, key challenges for implementation of QBL reporting framework, quadruple bottom line reporting framework. This I am just reading a little bit faster because we have very much discussed in depth in the theoretical chapter. So here I am going a little bit faster. The key challenges will be awareness of relevant issues. It is unable to find out that understanding the stakeholder requirements, and you have to align the QBL reporting objective also with the entity objectives. Okay, so these three should be nothing but risks of key challenges for implementation of the quadruple bottom line reporting framework, and therefore all of this will be my correct answer. Next part, external benefits of sustainability reporting include this also. We have been covered in a separate question, guys. external reporting, financial reporting cutting. 84, if you observe, enhanced link between financial and non-financial performance, improving the reputation and enhanced perception on organization value. See, this is not an external benefit. This is not an external benefit. Check the question there. We have clearly classified, sir, what is the external benefit, external reporting ka external benefit and internal benefit. We have clear cutly classified. Okay, so this is not an external benefit, so this should be ignored. If you want complete clarity, watch the theory once again. You just have to study the theoretical part once again so that you will be getting a clear cut clarity. So here the option will be both 2 and 3. So here the option will be both 2 and 3. Okay, fine, sir. So next part. Which of the following is or are benefits of XBRL reporting, sir? XBRL reporting, if you observe, sir, automated data processing, it is very much essential. What is the advantage? Next, improved reporting quality. Yes. Cost and time savings. Yes, because they have been using some taxonomy codes which are there. Rather than typing the full point, you can say remember the code and you can enter that code. So obviously cost and time both will be also saved, and quality reporting also will be improved, because nowadays this XBRL complaint companies will be following a uniform language in all the countries. Okay, so this language, this reporting language is common for all the entities. Therefore, this is the very much benefit of XBRL reporting. So I can say that all of this will become the value, which means that if you observe all of this, so I think 85th option will be 4. 85th option will be 4. Yes, sir. So last part, sir, XBRL stands for Extensible Business Reporting Language. XBRL stands for Extensible Business Reporting Language. Okay. Fine, sir. So 86 second option is the correct answer. Sir, EVA, economic value added, is nothing but no PAT minus WACC into invested capital. No PAT minus WACC into invested capital is the thing. So 87, no PAT. This one. So first option, no PAT minus WACC into invested capital. Okay, fine, sir. So next part. Dash report is an analytical tool for displaying human resources related facts, insights, metrics. Oh, blah blah blah. They have given some list of points, but aram se just slowly read the question for one time. You will aram se find out. Sir, it is clearly talking about human resource, HR operations. Therefore, it is very simple. First one, ESG will talks about environment, social, and governance. So that is altogether a different thing. CSR is also not correct. Sir, IR is also not correct. Since it is specifically related to human resources, option number 3 should be the right answer. Option 3 should be the right answer. Okay? Yes, sir. Corporate sustainability reporting helps the companies to assess and manage their sustainability impacts, report their contributions to sustainable developments, integrate the sustainability into their business strategies. If you observe, sir, CSR reporting, what is the impact which we are contributing towards the sustainability, that can be found out. Sir, how to assess and what to manage also have been clearly explained, and report their contributions to sustainable development. Even this point is also very nicely explained. This point also, sir, how exactly I am contributing, that will be reported. It is a kind of responsibility which the company should undertake, because they have been taking anything and more, everything they have been taking from the environment and society. Rather, they have to contribute something, and that contribution will be done in the form of CSR. Okay? So I can say that all of these will be the benefits. It will be taken care with the help of corporate sustainability reporting. Okay? Yes, sir. So next part. Which of the following is not a feature of government accounting? Which of the following is not a feature of government accounting? Not a feature of government accounting, they are asking. Sir, double entry system. No, sir. Government have to follow government. Government accounting also have to follow this double entry. Government regulations also should be adhered. Transactions through banks also should be done. It is fund-based accounting. They are saying non-fund based, so this should be wrong. Okay, this should be wrong. Next part. GASAB stands for Government Accounting Standards Advisory Board. So GASAB, so this one, Government Accounting Standards Advisory Board. And then IGAS 2, sir. IGAS 2, we have already know this part. It is covered in accounting and classification of grants and aid. I have already explained. You have to remember at least the standards names. IGAS 2, 1. Like this, we have to remember what they are trying to say. Guarantees have been covered in another standard that you have to remember. Which of the following is not a general principle of government accounting? Which of the following is not a general principle of government accounting? Reporting and utilization of public funds should be done. Minor heads, major heads, subheads also should be done. Budget based also should be done. So all these three have become the general principles, but the last single entry system is not the general feature. Single entry system is not the general feature. Okay, so option 4 should be the right answer. Standards developed for accrual system of accounting. This is important. IGFRS. We have already discussed that government entities will be following the cash basis of accounting, but in future they want to adopt to accrual basis, and therefore the government GASAB has been issuing different set of standards. Those standards are called as Indian Government Financial Reporting Standards. So option 3 should be the correct answer. 94th to option 3. 94th to option number 3. Okay. Yes, sir. So next option, which of the following are responsibilities of GASAB? Sir, GASAB, what is the responsibility? Formulating and proposing the standards that improve the usefulness of the financial reports. Yes. Keeping the standards up to date and reflect the changes in the governmental environment. This also. And improving the standard of government accounting and financial reporting. Even this also should be done. So all of the above should be considered. Okay. So yes, all of the above. Next part, as per the constitution of the India, the accounts of the government will be kept. This also we have know that consolidated fund of India, yes. Contingency fund of India is also yes, and the public accounts of India also. And where's public accounts of India also we have to keep the accounts. So this 96 little bit important. You just have to remember this 96 also, and 97 part also. So all of the above here will be the correct answer. Next part, the financial statements of the union government, state governments with legislature with respect to the public debt and other obligations are opening balance, yes. Additions, discharges, closing balance, net changes, everything should be recognized. With respect to internal debt also, with respect to external debt also, and with respect to any other obligations like guarantee, etc. Everything should be clear cutly explained with respect to public debt. With respect to public debt, yes, it is important. Next part, consolidated fund of India is referred in article number 264 clause 1. Sorry, article number 266 clause 1. Yes, this one. 264, no, it is 266 clause 1. Very, very important. You have to remember this part. 266 clause 1 mein they have defined consolidated funds of India. Just to check where it is defined in contingency fund also, you have to remember that part. The financial statements of the union government shall disclose the following details under loans and advances made by the government. So if you observe, very simple, sir, loanee wise, borrower wise, you have to give the summary of the loans and advances, and next to sector wise also you have to show, and repayments and arrears if there are any, that repayment also should be clear cutly specified in the standard itself. Okay, so this article 266(1) also, here all of the above. I think this part also all of the above, this also all of the above. Last part we all of the above, we have to take that part. Okay, yes sir. Okay, so next part, Cummins Limited acquired a machine for 65 lakh on 1st July 2022. It has a life of 5 years with a salvage value of 7 lakh rupees. As on 31st March, its present value of future cash flows is 28 and selling price is 25. They are asking you to calculate the impairment loss. Very simple. Okay, very, 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 very simple. You just have to find out the carrying amount on the date. The carrying amount on the date of 31st March 2025, you have to find out. And this should be compared with recoverable amount. And if recoverable amount is less than the carrying amount, then you have to bring back the carrying amount of the asset to its recoverable amount. That is the whole concept of impairment. So first let us find out the carrying amount as on 31st March 2025. Be very careful. The asset is purchased on 1st July 2022, which means 2.75 years are completed. 2.75 years are completed, which means 3 months are done. Baki 9 months is there. Till 31st March 2023, 1 year. 31st March 2024, 2 years. 31st March 2025, 2 years. Okay, 2.75 years. It is not 3 completely, 0.75 in the first, second, third. So 2.75 years are completed. Okay, so this will be the depreciation which it should be done. So depreciation amount will be 65 minus 7 divide by 5 into 2.75. If I do, I will get 31.9 as depreciation, but the cost is 65. Therefore, 33.1 should be the carrying amount. Recoverable amount is 28 lakh. Recoverable amount is 28 lakh. Therefore, the impairment loss will be 33.1 minus 28. Then 5.1 will be the impairment loss. Therefore, option B for 100 will be the correct answer. Okay, option B for 100 will be the correct answer. Understood, sir. So next part, just a moment. Just a moment. Okay, fine, sir. There's 101. So triple bottom line means it includes operating result also, recording result also, and last line also, which means all of this will be triple bottom line ka point. This is not that much considered as important, but just you can aram se remember. Triple bottom line is nothing but bottom line refers to profit. Okay. So last line, okay, these three can also be called as a triple bottom line. Therefore, all of the above should be the correct answer. Members of the Public Accounts Committee are elected by Lok Sabha and Rajya Sabha comprise of not more than, I think we have understood this part. We have to definitely remember this part. 15 members of Lok and 7 members of Rajya Sabha. This we have already discussed in government accounting. So this option 3 should be the correct answer. Option 3. Next. Sir, IGAS 1 talks about guarantees given by the government. Yes, IGAS 2 talks about grants in aid, but IGAS 1 to government guarantees given by the government. Next part. Important terms of employee share based payment plan. Intrinsic value is very important. Vesting period also should be important, and grant ka value. Okay, these three should be considered. All of these should be considered in Ind AS 102 share based payment ka standard. 105 repeated question, so I'm ignoring this part. Same figures we have already taken in the earlier. 106 leases related question, so let us quickly check this part. A company takes a machinery on lease for a term of 6 years at a lease rent of 4 lakh per annum at the end of each year with a guaranteed and unguaranteed residual value of 3 lakh. They are asking you to calculate the gross investment. Gross investment is very simple, sir. Whatever the total lease rentals, that is 4 lakh into 6 plus residual value to 3 lakh. Therefore, 27 lakh will be the gross residual value, and option will be D. If it is net investment value, you have to find out the present value. If it is net investment value, you have to take the present value of all these figures. But since it is a gross investment, very simple. You just have to multiply whatever the lease rentals plus any residual value if there is. You just have to multiply that part. Very, very simple. It's a question in days 116 related. Okay, fine. So net assets are 15 lakh. PC is 19 lakh. Sir, PC 19, net assets 15. Obviously, 4 lakh of goodwill will be coming now. So 107 option B. 107 option number B. Next, sir. The three pillars of sustainability. Planet is there, people is there, profit is also there. So all of this will be the correct answer. In case of amalgamation in the nature of purchase, fixed assets, current assets, total debts, debit balance of P&L account, purchase consideration, they have given all the figures. Sir, how you have to calculate? Very simple. Sir, PC to take 48 lakh. PC 48 lakhs, sir, there is no NCI in this question. So I will be adding whatever the assets and I will be deducting the liabilities. Debit balance of P&L account should not be taken over. So that debit balance of P&L account should be ignored. So rather than this, what are the figures? 51 lakh 20,000 to fixed assets plus current assets should be added minus normal liabilities should be deducted. Therefore, 53 lakh 60,000 will become my net assets. This should be ignored. Debit balance of P&L account should be ignored. But my PC is 48 lakh. Sorry, this is not. This 4 lakh 40,000 should be ignored. So it is 53 lakh 60,000 minus 48 lakh goodwill. If I do, I will be getting a credit balance of 5 lakh 60,000, which is called as a capital reserve. Which is a capital reserve ka balance. 5 lakh 60,000 I will get. Okay. Yes, sir. We have understood the concept. Next part. 1110, which is not a part of sustainability, economic sustainability, social sustainability, political sustainability, and again they have given economic sustainability. Okay. Economic is there, social is also there, but this political wala point is not there. Okay, so this should be the wrong answer. Political sustainability should be the wrong. It is not there. Sustainability means sustainability is nothing but environment, planet, social, people, and balancing out of economic factor means profit. Therefore, all of this should be considered. All of this should be considered. Next part, very simple. So, super profits under capitalization method. Sorry, under uh, annuity method. So, 18 lakh we will take. So, 18 lakh should be multiplied by annuity factor, that is 3.0374. 3.0374. 5467 320. That's it. 5467 320 will be the answer. So financial instrument is nothing but a contract, which is a financial asset for one party and financial liability or equity for another party. Therefore, all of this should be the correct answer. Okay. So what is purchased goodwill? Purchased goodwill is nothing but when payment is made in excess of net asset purchased. This is not correct. This is important. Net assets if you are paying more than net assets, then whatever the excess which you have paid, that will be called as your goodwill. So this is also done. What are the types of share based payment plan? Employee stock option purchase plan, employee stock option plan, stock appreciation rights, everything will be a part of share based payments only. Some share based payments will be settled to employees and some share based payment will be settled to non employees. Okay, so whatever it is, both will be everything will be treated as a share based payment plan only. What is net assets? Total fixed assets plus total current assets minus total current liabilities. Okay, this is the most sensible option. So let us set me option number 2. I will select. Yes, it is correct. Next, to whom employee stock option can be offered? Any person, Baba, whole-time director, employee, officer. To any person, it can be offered. So all of this. What is an eligibility of an employee who is a promoter to receive the option? Who is an eligible promoter to exercise the option? Always remember, promoter can never participate in employee stock purchase scheme. Promoter cannot take place in this employee stock purchase scheme because this is clear cutly available only for employees, and promoter, though he is not considered as a normal employee, therefore for him the stock option ka plan is never, what should I say, opted. What are the types of share based payment transactions? Equity settled is also there. Share based payment with cash alternatives are also there. Cash settled share based payment transactions are also there. Therefore all of this. Some equity shares, some payments can be settled on the basis of equity shares, cup price. Some are cash settled, some are settled by issue of shares, and some though hybrid options are there. Hybrid means at the option of the shareholder, it can be either treated as a cash settled or a equity settled also. Anything can be decided by the shareholder. Okay, fine, sir. Next part, 120 question. This question is also a little bit incomplete. This question is also a little bit incomplete from the institute's perspective. So what exactly they are trying to say, let us observe. Alpha Limited observes Beta Limited and shares are issued by Alpha Limited using the swap ratio 3:7, which means 3 shares will be given for every 7 shares. 3 shares will be given for every 7 shares is what they are trying to say. For example, assume the total number of shares of that Beta Limited are 3 lakh or 7 lakh rupees. How much? 7 lakh rupees. Then what they are trying to say is 3 shares of Alpha Limited will be issued if you are having 7 shares of Beta. So by 7 into 3 they will do. By 7 into 3 by 2, which means they will be giving 3 lakh shares. If you are having 7 lakh shares, they will give you 3 lakh shares. Okay, yes, the face value irrelevant for both the companies. Intrinsic value is 14. Okay, it is fine. The total purchase consideration is equal to, they have forgotten to give the total number of shares of Beta Limited. Now, if the Beta Limited ka shares are 7 lakhs, then we can find out like this. If Beta Limited ka shares are 2,10,000, then 2,10,000 divide by 7 into 3. If I do, I will be getting 90,000 shares. Ultimately, that information should be given in the question now. That information should be given in the question now. Since this is not given, we cannot calculate this part. Okay, whatever the number of shares you have identified, you simply should multiply this with 14 rupees. Okay, You simply have to multiply that with 14 rupees. And this cannot be done because question is incomplete in this question. This aspect, the question is little bit incomplete. Question incomplete. 121. Sir, where does employee stock option outstanding appear? It will be appeared in this only. SBP reserve. SBP reserve will be appeared in balance sheet only as a part of a net worth. XML stands for XML stands for extensible markup language. What is this? Relevant. It should be all of this. It is called as extensible markup language. Which institution is not under XBRL? See, this RBI and SEBI are covered under this XBRL only. This also we have nicely covered in the theoretical chapter, so you can to check that part. This part, when objective of the holding financial assets do not include collection of cash flows by selling financial assets, such see by selling, if your intention is not there, then we have to check amortized cost method. Then we have to check amortized cost method. Therefore, this will be the option. Which companies are exempted from XBRL? Again, I am saying this, you have to check from that part only. Okay, see, power sector also excluded, banking are also excluded, insurance companies are also excluded. This you will be getting a complete clarity only after reading that part only. Chairman of the Public Accounts Committee and CNAG are appointed by Chairman of the Public Committee will be appointed by Speaker of the Lok Sabha, and CNAG will be appointed by President of India. So Speaker of the Lok Sabha, Chairman of Public Accounts Committee, and CNAG shall be directly appointed by President only. Fine, sir. 127. Elora changes its method of inventory valuation from weighted average to first in first out. The accountant opines that Ind AS 8 is applicable. Elora should account for this change as. If it is an accounting estimate ka change, prospective effect should be done. Prospective effect should be done. But if it is an accounting estimate, prospective, sorry. If it is an accounting policy change, retrospective effect should be given. If it is an accounting estimate ka change, prospective effect should be given. Change in accounting policy, inventory valuation is an accounting policy, therefore, which should be given, sir. Retrospective valuation should be given. Therefore, the option will be this C. Okay. C ka option is the correct answer for this 127th MCQ. C is the correct option. Okay. Yes, sir. So next part. 128. Sir, what is the super profit? Super profit is nothing but average profit minus normal profit. Average profit minus normal profit. Okay, option number 3. They have given actual profit, but this should not be actual. This should be average profit minus normal profit. At the time of absorption, trade receivables of both the companies are having 35 plus 18 lakh. On that day, trade payable of B Limited includes payable to A Limited of 4.5 lakh. Sir, B Limited books mein payable is there, which means in A Limited also receivable should be there from B Limited. A Limited, B Limited ka books में sir payable का value is there, which means A Limited ka books में receivable is also there na, but that should not be written because intercompany transactions should be eliminated when consolidation. So 35 plus 18 minus 4.5 you have to do. Whatever the 4.5 which B Limited have to pay to A, that much receivable is also included in A Limited ka receivable. Therefore, that should be eliminated. So correct answer is 35 plus 18 minus 4.5. If I do 48.5 will be the correct answer. Therefore, option B. Okay, yes sir. Next, how can employee stock option can be offered? If any stock option should be offered, always remember special resolution in the general meeting should be done. Special resolution in the general meeting should be done. Then only this ESOPs can be offered. Okay, fine. Next part. Which of the following is not a general principle of accounting? Single entry. Already we have checked this part. Who are the users of XBRL? Users of XBRL. Now, investors are also there. Not for profit also. Companies also. All of this should be the correct answer. Okay, all of this should be the correct answer. Okay, we are coming towards end, guys. Milky Way is conducting research. Okay, it has already incurred 15 lakh rupees in the last year. During the year, it have incurred 5 lakh rupees each month as a part of its research expenditure on 1/5/2023. Directors find out the research is successful and is ongoing to bring a cash flow of 300 lakh in the coming years to the company. 31st March 2024, what is the impact they are trying to ask? We already know that, sir, if any intangible asset pay, if any research is made, till the technical feasibility got established, you have to charge that expense to revenue only. Balance, after establishing the technical feasibility only, you will be recognizing that expense as an asset. They are clear-cutly saying on this date, 1st May only technical feasibility got established. Therefore, for 11 months, 5 into 11 months, 5 into 11 months, 55 lakh should be treated as an intangible asset. And before that also, first month they have incurred 5 lakh rupees. So that 5 lakh rupees, that 5 lakh rupees should be treated as an intangible. That 5 lakh should be treated as an expense, and the balance 55 lakh should be treated as an intangible. So this 3 should be the correct answer. Okay, fine. This 300 is not the expense. They have estimated that it will bring 300 lakh inflow. Okay, fine. Which of the following is not an objective of government accounting? Government accounting objective. Okay, I think to facilitate the tax collection, they are saying, okay, this is not the objective of government accounting. This is an objective of, just a minute. This is not an objective of government accounting. This is an objective of tax departments. Okay, so this, the question where they're asking about government accounting. Therefore, this is there. Reliable data should be provided. Excess expenditure should be avoided, and misappropriation of government properties also should be done. These 3 are fine, but this is not the objective of the government accounting. Okay, fine, sir. Next, as per Ind AS 28, joint control, significant influence. Sir, what is the consolidation which is called as equity method of accounting? Therefore, this C should be the correct answer. C should be the correct answer. Next part, Cosmic Limited purchased machinery on this date. Okay, Cosmic Limited purchased machinery on this date. Sir, we just have to find out the carrying amount. Oh, such a lovable institute. They have only directly given the value of written down value. So, ठीक है sir. So, carrying amount. So, 18.27. Recoverable amount. So, 12.45. This is called as impairment loss. Okay, impairment recoverable amount is less. Therefore, 18.2427 minus 12.45. I will get 5.82 as impairment loss. I will get 5.82 as impairment loss. Last 3 MCQs are there. So let us quickly complete this part. 137 with respect to integrated reporting. Integrated reporting, which of the following is not true? An integrated report should not be a standalone report. No. The framework is done primarily for private companies. Not at all. A report containing a management can serve the purpose. No. Integrated reporting should be a separate thing. It is not only applicable for private companies. It should be a standalone report for sure. Okay. So these 3 things should be. Everything is not correct. Okay. So all of the above will be the correct answer. Which of the following is constituted under article number 266, clause 2 pay public accounts of India will be constituted. 266 1 may above we have checked consolidated fund of India. And last but not the least, which of the following is not a part of an earnings call? Safe harbor statement is there. Presentation and disclosure of financial results also will be done. Question and answer session also will be done. But examination of audit report will not be done in the quarterly calls session, earnings call session. For that, audit committee meetings and all number of things will be done. At that time, it will be done. Okay, fine. So done. This MCQ session has been completed. Okay, fine.